Hi guys, welcome back to my channel. Kelvin here. So, just how bad an average investor is at investing? A study by JP Morgan found that average investors earn just 2.6% annual returns during the past 20 years, performing just slightly better than the inflation. The CPF investment scheme also found that 40% of the people either perform lesser than the inflation or lost money when investing their CPF money. Somehow, the average investor consistently underperforms everything. It's like when you are young, your dad will always ask you, "Our neighbor Xiaoming always gets number 1 in class. Why can't you be like him?" In this video, I'll give you 5 reasons why the average investors consistently underperforms everything or lose money when investing. I will also tell you how to deal with your emotions when investing. I know how you feel. When the market crashes, you are like, everyone is asking how to invest, but no one asks how am I. There's a lot to talk about, so let's start right now. The first reason why people lose money when investing is they do not treat buying stocks as buying into the business. When we see a stock, let's say the fruit company, Apple, what do we see? We see the ticker symbol, the price, and whatever ratios they have. For most investors, that will be the only thing that they are seeing, and the news like to glorify stock price, like Apple soars into the close, or Apple slides 4%, or Dow rebounds more than 650 points. Whenever I see this kind of news, I'm like, damn lah. Let me give you an example. If your rich friend comes up to you and asks you, "Hey, you want to start a Thai fan store together or not ah?" I'm pretty sure your question is not, how much can I sell this Thai fan store tomorrow ah? You will ask more common sense questions like, what's the expected return of this store ah? Or, why will people want to eat at my Thai fan store ah? Or, how will we differentiate from the rest? Will we hire a Thai fan auntie that calls everyone 帅哥美女? These are the questions that any investor should ask, not just stock price every day. Stock price 你的头啦. Forget about the stock price. If you can see hints and signs that the company will do well, you will know that the stock will go up in the long term. And frankly, it is not hard to research about the company nowadays, especially with Google and YouTube. For example, a while ago Snowflake came out, right? If I want to research about it, I just need to go to YouTube, see what other people are saying about that stock. Do they think it is a good stock or it is overpriced? Find out what are the company's future plans, what are the possible things that can make it fail, and who are their competitors. How is the management of the company? Are they good? Or are they trying to cheat investors by showing a prototype rolling down the hill? Treat buying a stock as buying a part of the company itself. If you can find out whether your money has the potential to grow in this company and not just stock price every day, you will do well in your investments. Number 2, trying to time the market. Many investors, especially new investors, think that they are god of stocks and think that they can time the market. But if you are one of them, sorry to tell you guys, there's only one god of stocks, and that's Warren Buffett. All successful investors that we know of do not make their wealth by timing the market. Like Warren Buffett, our god of stocks, has once said this: "Our favorite holding period is forever." And the forever is like Wang Hong's forever love kind of forever. Not secondary school kids kind of puppy love forever, where they say "I love you forever" and they break up next month. There are tons and tons of research that proves that time in the market outperforms timing the market. First, a study by Charles Schwab analyzes 5 different investing methods from 1993 to 2012. What they found was pretty interesting. If you can look into the future and time the market perfectly, you will have made the most money. And as we all know, this is impossible unless you are Dr. Strange who can look into the future and see 14 million possibilities. Second, if you have invested immediately every time you get your money, or if you have just consistently dollar cost average, you will only perform slightly worse off than timing the market perfectly. But if you are trying to time the market and always time it wrongly, which is what most average investors and 40% CPF investors are doing, you will be making much lesser returns. It is super crazy. The more things you try to do, the lesser you will earn. But if you think about it, it makes sense. Because if you are holding a stock, let's say Tesla, it goes up 10%. Now you have to make 2 decisions. Should you sell? And if you sell, what should you buy next? If you make a mistake on any of these 2 decisions, your returns will be much lower. Another research by JP Morgan found this. If you have just held on no matter what, you will be earning 5.62% annualized return. But if you miss just 10 best days, your return will already drop by half. Miss by 20 days, your returns will be in negative territory. And here's the kicker, 6 of the 10 best days in the market occurs within 2 weeks of the 10 worst days. Remember the 2020 March crash when everything was dropping left and right? Right after those, the S&P 500 had its best days in terms of net change, and later the best 50-day rally in the history of S&P 500. So in short, if you want to do well in investing, just buy and do nothing. Number 3, when many investors invest, they do not think long term, like buy today, tomorrow want to be a millionaire already. Where got like that so easy one? If it was so easy, everyone would be a millionaire already. The S&P 500 has only delivered an annualized return of 10% over the past 90 years. But some people feel that it is not fast enough, so to compensate, they would rather day trade or buy some unknown stocks which is going up very fast just to make quick bucks. Here's a very simple analogy. Let's say you are driving from Jurong East to Changi Airport. You can drive super fast like 300 km per hour and get there within 10 minutes. But you might get into an accident or even worse, a saman. Or you can drive slow and steady, 80 km per hour. You will arrive in 40 minutes instead, but you will arrive much safer. Investing should be like that. If you want to arrive at your destination safely, or in this case, make money safely, go for the slow and steady method. If you look at any stock graph, like maybe Amazon, you will see all the ups and downs, like the potholes in some countries' road, Malaysia. But if you zoom all the way out, the trend is very clear. A good company stock will only go up in the long term. In fact, it was found that S&P 500 has never once delivered a negative return over a 20-year period. Don't get me wrong, I'm not saying that it never will. I'm just saying that history has shown us that the longer we invest, the lower our chances of losing money. As Benjamin Graham Coco once said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. In the short term, prices could be manipulated, markets could act irrationally, and analysts could shout that a crash is coming every other day. But if you just buy and hold over the long term, ignore all the market noises, and let the company do its work, you'll be making money 99.999% of the time. Number 4, over-investing the money that they need. This is pretty simple. Investors lose money because they are over-investing. Never ever invest the money that you need in the short term. And by short term, I mean anywhere within 10 years. Let's say if you need to marry and buy BTO with your BE next year, and you need 50k for that, don't invest that money because someone has done that before. And just in case you're wondering, no, his wife did not leave him. No matter how safe you think an investment is, there's always a risk to it. Like the market could crash and burn tomorrow for all we know. Tesla could just go from 500 to 330, then back to 450 in just a matter of few days. There's a quote, market can remain irrational longer than you can remain solvent. Like I remember during the March crash, when the market went down almost 40% in a matter of weeks, everyone was panic selling. Most people would have sold right at the bottom because they were scared that the market could crash another 20 to 30%. Right after they sold, the market recovered. After that, many so-called professionals were warning that another crash is coming, but it never came. The reason people will sell is because they were over-investing the money that they need. When they lose their jobs or their business are failing, which is often the case when times are bad like a recession, they will be forced to sell off their investments at a huge loss. A way to counter this is always to have 6 to 12 months worth of emergency funds put aside. So whatever you are investing from today till the next 10 years, make sure that you do not need those money. And that ties in with the 5th reason, using emotions to invest. Maybe your stocks went up, then you decide to all in your money because you have fear of missing out or FOMO. Or if the stock crashes, then you decide to panic sell because you didn't understand the company. There's a quote, be fearful when others are greedy and be greedy when others are fearful. If the stock went up 10%, 20%, ask yourself this, am I comfortable holding this stock at this price for the next 10 years? Only buy if the answer is yes. Or if the stock price is crashing, instead of viewing it as a bad thing, view it as a good thing because now you can buy your stocks at a massive discount. You certainly wouldn't run away from discounts at the shopping mall. So why would you run away from discounts at the stock market? Why do you use emotions to invest? Having gone through the 2020 March crash myself and having seen my green portfolio drop by over 40%, becoming super red, I understand that it is much easier said than done. Be calm, he said. Don't run away from discounts, he said. So I'll give you a few tips on how I told myself everything is fine when the room is on fire. First, as mentioned earlier, you need to understand the companies that you are investing in. Are they good companies? Can they withstand a recession? If it is a good company, it will be like those movies where the main character is defeated but come back stronger. In that case, you do not have to panic sell, but instead buy more of that stock. Second, have an end goal in mind. I found that this has helped me out tremendously. My goal is to achieve financial freedom in the next 10 years. And that means I can't make risky investment decisions. Like, I won't be able to trade Nikola just for quick profits because if I lose, I will be set back. And also, when I have a goal, I won't be able to do random stuff like time a bit of the market here or time a bit of the market there. But instead, I will have annual targets to hit. And the easiest way to achieve that is to dollar cost average, which is just consistently adding more money every month and let the market do its thing. Third, don't look at the stock market every other day because if you do so, it will really wreck your emotions. Like, if you are invested in the US stock market, the moment you wake up, you go and check your stocks. If you see it go up 1%, you are super happy. But if it goes down 5%, you'll be super depressed for the entire day. As I said, it doesn't really matter what the market does in the short term. Even if it goes down, as long as you do not sell, you do not lose money. Just wait it out. If it is a good stock, it will recover back. Fourth, if you are the kind of person that cannot handle volatility, maybe you are investing in the wrong asset class. If that's the case, you should not invest in individual stocks, but instead invest in ETFs or index funds. There are many great ETFs that give super good returns like innovation ETFs, ARK ETFs, technology ETF, SSLK or QQQ, or even the simple S&P 500 ETF. They are much less volatile, much more diversified, and can give good returns. So those were the 5 reasons people lose money when investing. What other reasons you know of? And how do you keep your emotions in check when investing? Comment down below. Like, share, and subscribe as I'll be posting new videos every Monday. See ya!